Oh, test 1 2 3. Joshua, how are you doing, Joshua? Welcome. Hey, Michael, how are you doing? Hello again, everyone. Welcome to another edition of Silver Bullion Television, SBTV. This is our live stream. Hope everyone is doing well out there. I know for most of you it's Sunday night. For the rest of us, it's Monday morning here in Asia. So we hope everything's going well for you folks, and we thank you for being here. DKD, hey, how you doing? First time I think I've seen you here. Pudenda Johnson, how you doing? Check 1 2 3. Hey, how you doing? Uh, excuse me, Rod Brumley. How you doing, sir? Good to see you again. Alan Davis, Michael, Joshua. Great. Glad you guys could make it here today. Again, hope everything is going well for excuse me, everyone out there, wherever you might be. And as I said, it's Monday morning here in Asia. So first thing we want to do is take a look at the markets. But before we do that, if you are new here or you haven't already done so, please do subscribe to our channel. Click on the bell to be notified on updates and give us a thumbs up. If you like what we do, we appreciate your support. And again, we thank you all for being here. And you can find us on social media at a few different places. Our website, silverbullion.com.sg, SG again because we are in Singapore. Facebook, Silver Bullion SG. Twitter, Silver Bullion PL, PL for private limited. The audio versions on iTunes, bit.ly, SBTV iTunes, and bit.ly, SBTV Spotify. And you can find us on Telegram. We have a little Telegram crisis tracker group, which I put the link up in the beginning of the chat box. I'll go ahead and see if I can put that for you one more time. Hang on. Okay, so this is the link once again for the Telegram group. Do hope you join us there because we do try to post a lot of information pretty much daily as it pertains to gold and silver or the markets and things like that. So let's move over and check the gold and silver price and see what's going on over in Asia. So again, this is our website, silverbullion.com.sg. Silver 1751, a little bit on the downside, not too bad. Gold, basically both metals are unchanged since Friday, so they're both hanging in there. Silver to gold ratio still just under 85, so it is definitely a good time to be buying some silver if you haven't already done so. It's a little bit of a dip compared to what the prices were a month ago. So again, that should be also a good indicator that it's a good time to buy. It seems lately nowadays we all need to be buying dips. So again, thank you all for being here. And some other news that we came across, and we've been talking about it. Last week we saw GE where they mentioned they're going to freeze pension plans for about 20,000 U.S. employees in a bid to cut debt. Remember now how we mentioned a pension is nothing more than a promise. So again, here we see promises perhaps being broken or modified in some ways. But nonetheless, GE said last week it was freezing the pension plan for about 20,000 U.S. employees with salaried benefits. The industrial conglomerate is trying to slash its huge pile of debt. The move will also help reduce the company's pension deficit by about 5 billion to 8 billion. So just take a quick look at what they had to say. It was freezing pensions for 20,000 workers. Okay, we read that. Since taking over a year ago, CEO Larry Culp has carved out a number of measures to streamline the company and raise cash to pay debt. He has also chopped the company's dividend to a penny. GE and its finance arm had total borrowings of about 105.8 billion as of June 30th, with industrial net debt at 54.4 billion. The company said it would also freeze supplementary pension benefits for about 700 U.S. employees who became executives before 2011. GE's pension plans has been closed to new entrants since 2012. See if there's anything noteworthy here as well. The company said it will offer a limited time lump sum payment option to about 100,000 former employees who have not yet started their monthly pension plan payments. Okay, so we're seeing GE kind of having to bend, not necessarily break a promise, but they're surely bending a promise that they had made to their employees. So, like we said, pensions a promise, and if you are, into pensions, you got to realize that they are, at risk, as well as 401ks. They are at risk, especially the 401ks. A lot of you guys, I know a lot of you out there have 401ks. So again, I can't stress this enough, and I will continue to stress it. Where do consider a self-directed IRA, SDIRA for short, where you can go ahead and get yourself a precious metals IRA, take some of those 401k earnings off the table, put it into precious metals, and have a little bit of safety there in case anything should happen. Because as I say, that same stock market that has taken your 401k up is that same stock market that's going to take it right back down. So you may want to be looking at what you can do to protect yourself. Okay, looking at the chat box, here we see I just said how you doing, Josie? Big nickel inventory drawdown, LME warehouse. Nickel, yeah, keep an eye on it. I mean, I know most of us here are for gold and silver, but there are a lot of positive things with nickel, and it's just been silently doing its thing. So you may want to take a look at nickel. Um, and nickel, just to give a plug for ourselves, I guess you can absolutely buy physical nickel from us in 250 kilogram drums. So there is a place for you to be able to enter into the nickel market. It's not as complicated as you think. Let's see. Yvonne Nutter, sorry. In UK, I checked government site to find out about our triple lock pension. It said unavailable pension system under review. Uh, okay. Yeah. I tell you, it's not just pensions in the US, it's pensions all over. And last week we spoke with Mark Valek, and even he had to say that generally speaking, pension funds in Europe are underfunded. So it's not just in the US, it's all over the place. Okay. Christy, Fernando, what do you think of the complete nothing burger of a trade deal last week? I think it's a complete, I think they're making progress. I think, not everything is going to be said. We're never going to know everything about it. But, there must have been something halfway decent in there, because we did see the stock markets settle a bit. And, they perceived whatever news coming out from Washington to be better news for the market. So, it's tough to say right now, because it's a long process that they have to go through still. And if it's a line by line thing, it's not going to work. They're going to have to batch things up, and when you batch things up, not each side is still going to have things within that little batch or tranche that they're not going to want to give up. So it's just a process. It's going to take a while. Let's see. Alan Davis, how much silver should I buy? 1,000 ounces or more? You buy whatever you're comfortable with. Um, some people have a target, like you mentioned, 1,000 ounces. Other people, they will just continue to buy. They will continue to buy and buy and buy, because they understand the concept of being your own bank, where if anything should fail with the fiat system, you need to have something outside of the fiat system. So I mean, having a target works for some people. Having a target is not necessarily the way to go for other people. It truly depends on your outlook. Moving on to some other news, our old pal Ben Bernanke. Interesting, where he came out earlier in the month. This is October 3rd. So earlier in the month, he says that the Fed has the tools to combat the next recession. Unconventional policies amount to 3 percentage points of rate cuts, former Fed chairman says. All right, so let's dig into it a bit. Federal Reserve has more ammunition to fight the next recession than many people think, according to a former leader of the U.S. Central Bank. Much has been made by the fact that the Fed historically has been able to cut interest rates by about 5.5 percentage points to revive the economy after a recession. Yeah, we hear a lot of people, they mentioned that it needed to reach five. So here we have Bernanke writing in to explain a bit about it. And there is a concern in the area of low interest rates. The Fed's benchmark rate is now in a range between 1.75 to 2%, giving them relatively less space, roughly half the space to operate in. And market experts like Jim Bianco, president of Bianco Research, think the days of Treasury bonds getting a 4 to 5% yield are long gone. That's a pretty heavy statement. All is not lost, according to Ben Bernanke, who led the Fed through the aftermath of the Great Recession. During a panel discussion hosted by the Brookings Institute, he estimated the Fed's so-called unconventional policies, if used wisely, are the equivalent of 3 percentage points of interest rate cuts. Those policies are forward guidance, bond buying, commonly called quantitative easing, and a new policy framework that includes strategy, a makeup strategy for inflation, he said. So I guess because the Fed didn't get their target 2% inflation, they are going to implement a makeup strategy or have a new policy framework that includes a makeup strategy. So we gotta wonder what this is. And the article even mentions bond buying, commonly called QE. Well, this time around, they're not calling it QE yet, are they? Okay. Getting back to some of the chat here. Truth Teller Fed could print up all the money they want. It's not backed by gold. You know, it you can't deny that. I mean, they can they can print. They can print for sure. Uh, I like coins over Joel Johnson. Okay, coins. Yeah, they're more divisible than bars are. So there is a point to having coins. But the point to having bars is usually you're going to get bars at less of a premium. So that's the point for bars. So they again, it just depends how you see things. Let's see. There is a less chance of getting a counterfeit when you get a maple. Um, you know, the mint is trying to do their job implementing all of these things, but I tell you, you can go to websites and you can buy counterfeit coins for $2, $3, and that's a troubling part because you can buy these counterfeit coins and you can easily sell them off. And again, you need to have a dealer where you got to make sure that everything they sell to you is tested. It has some type of a genuinity guarantee because if these people were to slip in, let's say, 2 to 3 counterfeit coins in every tube that they sold back, and let's say they took 10, 15, even a monster box back to the dealer, and if the dealer doesn't open it up and check it at some point, he's going to sell it right back into the marketplace, and you're going to end up buying counterfeit coins. So again, this is another important reason why you need to have your coins tested. I can only speak for us where whatever comes in, it's getting tested, and on the way out, you know, it can be tested as well for you if you ask. So that's something you need to be doing, is to make sure your coins are real. The mints are trying to do their job, but honestly, it's getting counterfeits are getting pretty good, but there are still ways you can tell. Like if you notice your 20-gram gold bar is pretty huge for just being 20 grams, chances are it's not a real bar. So you need to be familiar with what you're buying as well, because some of the responsibility, it's on us, or it's on you. So we all have to know what we're buying and make sure of what we're buying. Okay, let's see. Would you invest in SLV? Me personally, no. I don't see the point of SLV. I mean, if you just want a quick turn and make some cash, I guess that could be something for you to do. But I think most of us here we're more into understanding the insurance aspect of gold and silver, and SLV doesn't cover that insurance aspect because it's not physical, and physical is what you want and what you need. Okay, let's see. All right, so let me get into another piece of news. This was fairly recent, and I don't know if this was shocking or not, but Federal Reserve Bank of New York issued a statement regarding Treasury bill purchases and repo operations. So this is dated October 11th, so fairly recent. In light of recent and expected increases in the Federal Reserve's non-reserve liabilities, the Federal Open Market Committee directed the desk, effective October 15th, to purchase Treasury bills at least into the second quarter of next year to maintain over time ample reserve balances at or above the level that prevailed in early September 2019. The committee also directed the desk to conduct term and overnight repurchase agreement, what's known as repos, at least through January of next year to ensure that the supply of reserves remains ample even during periods of sharp increases in non reserve liabilities and to mitigate the risk of money market pressures that could adversely affect policy implementation. In accordance with this directive, excuse me, the desk plans to purchase treasury bills at an initial pace of approximately 60 billion per month starting with the period from mid-October to mid-November. These reserve management purchase purchases of treasury bills will be in addition to the desk's ongoing purchases of treasury securities related to the investment of principal payments from the Federal Reserve's holdings and agency debt and agency mortgage backed securities. Here we go again, right? Detailed information on the schedule for reserve management purchases of treasury bills will be announced on or around the ninth business day of each month on their website. Consistent with the directive, desk the desk will roll over at auction all principal payments from the Federal Reserve's holdings of treasury securities. As treasury bill holdings mature, the principal payments will be rolled into new treasury bill securities. Okay, so let me just scroll down a bit, see if there's anything else important here. Okay, so that more or less is it. Where they're not announcing QE. I think there was those little memes going around. You know, this is not QE. Don't call this QE. Um, I don't know what you would call it at this point. But I think for me the more disturbing thing is Jerome Powell came out and he told us this is temporary. He came out and he told us this was just for these banks. They got to pay their corporate taxes or whatnot. This that. In a nutshell, and I'll just say it. He basically lied to us. He didn't tell us the truth. Definitely not 100% of the truth. I don't even know if it was 10% truth. But Jerome Powell did not come out and tell us the truth. And what can you make of it except to say that they're hiding something? There's something we shouldn't know. They're trying to hide something. And for me, why I say that's dangerous is because when you go back to 2007, 2008, the only time they told us anything was when they said we were 2 days out from a complete global financial meltdown or whatever it was. In other words, they weren't going to tell us anything. They were not going to tell us anything at all until it was actually happening and we couldn't do anything about it. And that's the dangerous part where 2007, 2008, we saw how the Fed operated. They weren't going to tell you anything, nothing at all. And we're seeing it again where those things that Jerome Powell had said as to why the Fed had to go into the market and handle some of these repo operations, his reasoning or his reasons why they did it, it's obviously not right. And for some reason, you don't see anyone in the media calling out Jerome Powell and asking him pretty much, why weren't you truthful with us? What's really going on? And that's the part that's kind of bothering me right now about it. Um, okay, looking at some of the chat again. Let's see. What kilo gold bars you have that any gold bar can be shiny. Anyone. Let's see. Ride the curve. This is permanent and it won't end well. Yeah, ride the curve. I'm with you there. It does seem like permanent. We've been hearing that word POMO tossed around. POMO, permanent operations. So it could be. Cyber. Since when do you trust bankers to be shocked when they like? Got to give everyone the benefit of the doubt, right? I mean, there's got to be everyone has some good in them, right? So going off of what Jerome Powell said. I think we all kind of knew, something didn't sound right, but now we know it was definitely not correct. So let's see. Cyber, this crisis is different than the 2008 because they keep it hidden, total denial. Yeah, this one, you, you gotta really dig and dig and dig. And if you find something looking this way, something's there, you got to look that way. Look this way, look that way, look up, look down. It's 360 degrees. There's something coming from every single angle. And, it's difficult to keep up with. But the overall um, picture of it is that things are not, more than likely, are not going to end well, just like what you had said earlier, what Ride the Curve had said earlier. James, the trolls are out tonight. Well, that's a good thing, right? I mean, we all must be doing something right if they need to come here and bug us, right? So let's see. Tony Pedersen, yes, China is very good with the new anti-friction alloys. Now even three-dimension. Okay, I gotta look into that, Tony. I see a orange. So I thanks, Tony. Appreciate it. Not too familiar with what that orange thing is, but I know it's something good. So I want to thank you for that. Let's see. Nameless, I like the Simon Black on your show. Simon Black, he's been around. He's seen a lot of things. He's been around. He questions a lot of things. And one thing that's genuine, actually many things, but one of the things that are genuine about Simon is he cares. You know, he's letting you know things because it's things you need to know. It's things your family needs to know, and that it, he's very genuine. And I don't want to say it's something you don't find that much in people nowadays. Because there's always hope in people, but he's a he's a genuine guy, and that's one thing great about Simon. And from the time I've got to know him, that's one thing I appreciate about him is his genuinity and his being honest. He's gonna tell you something whether you want to hear it or not. He's gonna lay the truth out for you. So something to appreciate with him. Okay, so last week we had Jeff. Not last week. Have been not for a week. Sorry about that. The other week we had Jeff Deist on, and in that interview, he had a few things to say. Jeff Deist is he's the president of the Mises Institute. It's a libertarian. No, I don't want to call them libertarian organization, but they're they pretty much. I guess you could in some sense, but Jeff he has a lot of different insights as to things, and so one of the things he had to say in this clip, uh, it intrigued me a bit. He mentioned about how bankers they can get money at a discount when in fact if they're getting money at a discount that means something's going wrong where they need cash and they should be penalized. So Jeff, he talked a little bit about that here.
Um, the Fed really was designed to be a backstop. It really was designed to provide liquidity in a crisis for commercial banks. And in exchange for that liquidity in a crisis, which almost by definition meant that the commercial bank had mismanaged things because it was coming to the Fed hat in hand, needing cash, that they would pay a penalty rate, that they would pay a higher rate of interest than they might have earlier gotten in the marketplace when they were more solvent. But what ought to be a penalty of borrowing money from the Fed or getting new cash reserves from the Fed has actually become a discount. We have a Fed funds rate which is exceedingly low. We even have interest payments from the Fed on excess reserves parked at the central bank. So we have a very upside down system where instead of being the lender of last resort, the Fed has become an active participant in the economy. It's buying up Treasury debt. In the QE program we've seen over the last 10 years, it bought up worse than Treasury debt. It bought up collateralized mortgage-backed securities and all kinds of stuff that still has not been marked to market. God knows what that's really worth. And so the Fed as a player, as an active participant in the economy, and always there as a buyer of last resort for treasuries, means that Congress can be profligate and spend more than it brings in taxes. It's very, very scary. And look, the Bank of Japan, the Bank of Switzerland, other central banks are even more activist. They're actually buying equities. Imagine if the Fed started buying Facebook and Amazon stock. It's not unthinkable, and it might be coming soon.
Okay, Jeff Dice with some pretty strong views, and I'd have to say I agree with him. Should banks pay a penalty instead of getting a discount when they need more liquidity? And I think he's right. I mean, there's nothing to stop banks from continuing doing what they're doing because they know the Fed is basically going to bail them out, and they can get cheap money doing it. So what's there to stop them from it? So Jeff, completely agree with you 100% there. And the other interesting thing he said was how Japan ECB is already buying up equities. So what would it be like if the Fed were to buy up things like Facebook or Amazon, whatever it might be? And we know that there is a Fed trading desk, and we assume it to be that they are already doing these things. So I went in and found this little clip about what more or less really happens at the Fed trading desk.
So in a typical day on the trading desk, it begins actually quite early in the morning. We'll have a group of traders that come in around 4:30 in the morning. They come in when it's still dark, no one else is really in the building, and they begin to make phone calls to the parts of financial markets that are already awake and fully running. So typically we're calling London and Frankfurt, Japan, starting to find out how conditions are in trading markets. And in particular, we'll be reading, of course, news lines, headlines coming out over the different wires to see if there's been any market-making news that might be driving the price action that we're observing. And what we're really looking for is to try to understand why are key markets responding in certain ways. So if we see German bonds yields rising, we'd like to understand why are they rising? What are the fundamental reasons that we see this movement? And then to try to think about what would that be, what would that view, if there's a fundamental reason to see German bond yields rising, what would be the consistent view across all asset prices? Are we seeing something similar in other sovereign bond markets? Are we seeing something moving in equity markets? Typically, we also try to think a little bit about the context of these moves. Are they large moves, or are they moves that we see daily and really something that we're expecting every morning or every season? So after we do a little bit of market intelligence gathering, we'll meet around 8 in the morning to have a discussion with the entire desk, which can be as much as 60 people, to talk about what we're seeing and think about what are the right questions to investigate over the day. Now, we're thinking in particular about our audience, who are generally other Federal Reserve presidents and staff at the Board of Governors. And what we're trying to do is help them understand whether or not markets are functioning in a normal way. Are transactions happening at the right, at market clearing prices, at volumes that are typical for this time of day or this time of year, or given the information we have? And if we do see something atypical, how important is it? So in addition to watching all the price action on Bloomberg screens, for example, we're also talking to traders and strategists to get their take on the markets. And this is pretty much what we do throughout the entire morning. And we have a group of strategists, each of whom has a specialty function. So there will be a team of people who are specializing in treasury markets, but some will specialize in looking at the short end of the treasury market versus the long end of the treasury market. And they'll all come together at this 8 o'clock meeting to try to discuss what they're observing. Throughout the day, our main objective is really to understand how the markets are trading and whether they're functioning normally. So, in addition to
Okay, I'll kind of end it there. So you can see how the Fed, does monitor, but you gotta kind of wonder the way this woman puts it, where it's not too far fetched to understand that the Fed is actively looking at the markets, and when she says things like, is it trading, I don't know if she used the word correctly, or whatever it is. What is correctly? Well, I don't know if she used those exact words, but in the Fed's mind, the market should be trading a certain way, and if it's not, I guess they're trying to understand it, is what she's saying. But the market should be operating a certain way, and again, my question is, for who? I mean, for who does the market need to be operating a certain way? That's the puzzling part for me. I don't think the Fed is in there buying Facebook or anything else like that. I mean, she didn't even come close to saying that. But if it were, I don't think she would have said it anyway. But she didn't give the impression that the Fed does those types of things. But still, just the part where Fed is actively monitoring. I mean, I could understand researching. The Fed actively researches, but monitors, you monitor to try and find something. If something goes wrong, you try and fix it. So I'm not sure if how to take the word monitor. Yeah, how which way we should be taking it. Okay, but anyway, some of your chats. Let's see. Mick, Fed are scoundrels, always changing their scheme to keep the swindle going. Well, they make the rules, and the best we can do is understand that, if, like I said before, if the banks are buying gold, you buy gold. If the banks need more cash, then you need more cash. In other words, don't necessarily keep it all with them. I mean, just do what they do. Try and look into what they're doing, and do the best you can to, in some ways, mimic what they're doing in some ways. Not everything though, but in some ways, do what you can. Uh, James Mayo, manipulation. I think I think we'd all have to agree. There's definitely manipulation going on, and it's getting more and more difficult to really find true prices on anything. On anything. Fixed means buy. Okay. Let's see. Swiss national banks are a large Facebook holder. I've heard that. I haven't looked into it, but I've been hearing that quite a bit lately. How they do hold a lot of Facebook. Nameless. What's better than a maple leaf or American buffalo coin? Depends. I personally like buffaloes. I think they're my favorite coin. So let's see what else is going on there. Okay. So anyway, we had Jeff talk about how banks should be penalized, not given discounts, and how he mentioned, what do we do if one day the Fed goes to buy up Facebook and things like that, and so again, wanted to look a little bit more at the Fed trading desk, see more or less what exactly goes on there. Let me see if I can make this larger for you guys. Hang on. Okay. Okay, so credit and liquidity programs and the balance sheet. This is from the Fed. Oops, hang on. Okay. Open market operations, the purchase and sale of securities in the open market by a central bank, are a key tool used by Federal Reserve in the implementation of monetary policy. Short-term objective for open market operations is specified in the Federal Open Market Committee (FOMC). OMOs are conducted by the trading desk at the Federal Reserve Bank of New York. The range of securities that the Federal Reserve is authorized to purchase and sell is relatively limited. The authority to conduct OMOs is found in Section 14 of the Federal Reserve Act. Okay, let's move on a bit. OMOs can be divided into two types: permanent and temporary. So here we see that word permanent again, right? Permanent OMOs involve outright purchases or sales of securities for the system open market account, Federal Reserve's portfolio. Traditionally, permanent OMOs are used to accommodate the longer term factors driving the expansion of the Federal Reserve's balance sheet, primarily the trend growth of currency in circulation. Okay, so let me read that again. Traditionally, permanent OMOs, which a lot of talk is making it a permanent, a PMO, it's not some type of on again, off again thing, but a permanent thing that's going to be there always, 24/7, I guess, are used to accommodate the longer term factors. So they need something to accommodate longer term factors driving the expansion of the Fed's balance sheet. So this is what it's about. They're going to pump up that balance sheet again, and primarily the trend growth of currency in circulation. So I think more or less that's kind of what we need to know. What's going on? Fed is they are going to pump up that balance sheet again, and we're already seeing it. It's no surprise, but the reasons why they're doing it, that's the part that's still is a bit of a mystery for us. We're trying to understand why are they doing it? Why are they telling banks, hey, or why is the bank saying we need help here? Take our securities, give us cash. We need cash. So why is the bank saying that? And it kind of makes me wonder. Kind of makes me wonder. I'll just throw this out there for you guys can kind of hash it out on your own. Kind of makes you wonder. Okay, we know Jerome Powell wasn't entirely honest with us, but it kind of makes you wonder. Everyone's been saying for quite a while, watch the bond markets, watch the bond markets. Bond markets are going to get in trouble. This, that, this, that, this, that. I mean, I'm just throwing this out. Does it make sense where, what if it was a reverse where the Fed knows that there's going to be trouble with the bond markets and is telling the banks, hey, give us your bond, give us these securities, give it to us. We got to get it off your books before something happens. What if it's kind of working in reverse, but they're just not saying it? I mean, I don't know. I'm just kind of throwing that out there for you guys, where it's a type of a reverse repo in a sense, and reverse repos do exist. But what if it's what if it's somewhere along those lines where people know the bond markets, treasury markets are, it looks like they can be getting in a bit of trouble. So what if it's the Fed actually recalling those treasuries in a sense to get it off the bank's balance sheets? Don't know. I mean, we just don't know. The Fed hasn't been entirely honest with us anyway, right? So it's another thing to kind of throw out there. Is this what's really happening? Who knows? But anyway, I'll let you guys hash that one out. It may be a crazy thought, but you just never know. You can't box yourself into just one idea with what's really going on. So anyway, looking at some of the chat again. Let's see. Look at all RR. Look at all the fiat currencies in the world all going down. Yeah, and that's the problem, because when these currencies go down relative to the US dollar, it makes exports a little bit more expensive, and it makes US products look a little bit less attractive. And that's something you just don't need right now when you're in a trade war, so when the rest of the world's currencies start to go down, that kind of it doesn't help the situation. And I think that's why you know President Trump has been calling for a bit of a weaker dollar, because he sees these things happening. And it kind of makes sense where if these other currencies are going down relative to the dollar as well needs to go down. And it's I mean, what is this? Is Has everybody thrown on a parachute and it's a race to, or a slow fall to the bottom? Kind of seems that way sometimes, right? I mean, central banks have thrown on a parachute, took the plunge, and and just casually drifting down towards the bottom. And who knows what's going to happen when they get there, though, right? Okay, James Mile makes sense. Okay, um, RR Fed wants to weaken the dollar also. Um, he, I, I think I think they do, but their mandate makes it tough because their mandate, two things they got to do is try and maintain employment, um, which more or less is there, but the other one is the purchasing power of the dollar. I believe it's the purchasing power of the dollar, stable prices. So if I think they may have to move slightly out of their mandate if they want to weaken the dollar. So I'm not sure what their feeling on that is going to be. And I think we already saw at the last FOMC meeting, the Fed was already starting to split. Some people dissented, some people went for the rate cut, some people didn't want the rate cut. So they're already starting to split. And I think the next FOMC meeting is may even show more of a split. So we're gonna have to again see what happens with that. Joel Johnson, parachutes for everyone. Yeah, definitely parachute. Golden parachutes. Okay, let's see. Okay, so that was a couple of the things that when I took a look at the Fed's trading desk, because I think we hear about it, and we're wondering what exactly are they buying at the trading desk. So it there's a concern there, but from the looks of it right now, I mean, it doesn't show that they are really in the markets buying up Facebook, Amazon, things like that. But how would we know? I mean, it's still tough to tell. Anyway, getting back to Jeff Dice, he said another interesting thing about the IMF, because like I say, if all these currencies are starting to drift into negative rates, something's going to have to be done. Whether it's a new currency or whatever it is, something's going to have to be done. And Jeff, he had some pretty interesting thoughts with the IMF, and I'll roll that for you. It's just a couple minutes. You mentioned IMF. When you mentioned them, it seemed like you had a little bit of concern in your voice. What concerns you about the IMF?
Well, I think that if we have another crash in the economy, I think it'll be a global crisis, just like 2008 was,
Yeah.
because the United States and Western Europe, when they get the flu, the whole world gets a
Right.
cough. And I think that if there's another crisis, that'll be used as an excuse to create another layer of governance over us. In other words, the free market will be blamed when in fact central banks are anything but free market institutions. And so the IMF and other people in places like the European Union and the UN and the WTO will say, look, we can't keep having these currency shocks, and we can't keep relying on sovereign, independent central banks to conduct their own monetary policy because it affects everyone else. So we need one central bank running everything. And so we need to start with the IMF creating a basket of currencies, maybe that would include gold and silver, but also the yen, the Swiss franc, the dollar, the euro, et cetera, and that we use this as kind of a yardstick or a proto currency. But then that could ultimately become just a form of special drawing rights, which have existed at the IMF for decades, and we could end up with an SDR standard instead of a gold standard or a dollar standard. And so I think there's a lot of sort of pent-up demand for a single global currency and also a single global central bank running everything. And I think if there's another crisis, again, capitalism will be blamed, sovereignty will be blamed. So it's very frightening.
It's very frightening, Jeff. I I agree. It's very frightening. IMF taking over the monetary system. Is that okay with you guys? I mean, for that to happen, we're really going to have to see some not too pleasant things happening along the way if the IMF were to take over the monetary system. Would it be okay with you guys though if they did, or do you still want your own type of sovereign currency wherever you're from? So I'll go in and take a look at some of the chat again. Um, excuse me. Full name: IMF have the SDR already. That is true. They already have their basket of currencies. The gold is included in it, and in 2016 we saw China's yuan also included in that basket of currency. Joseph Godinez, Bold Ponies Gold Forecast, Bold Ponies 2020 forecast says silver will be the new item that opens the door to luxury. Well, remains to be seen. Bold Pony, he's had his ups and downs for sure. I mean, if any of you guys know or follow him, he's had a lot of ups and downs lately. He had to go dark for a while after a few predictions that really didn't materialize at all, and he's sticking his neck out again, and trying to give people the best insight as he sees it to be. So because he says silver will be the new item that opens the door to luxury, let's give Bo a chance again. No, but he does give some a lot of information that does make you think a bit. He doesn't spoon feed you. He's going to make you think about things. So that's a good thing about Old Pony. Tony Peterson, I personally won't buy gold until the gold to silver ratio gets to below 50%. Okay, you're a stronger man than me, Tony. I think if it got 65, about there, 65, 60, it would be hard for me to not look at gold at that point. So okay, you got more staying power than me, but definitely for the time being right now, it's silver. It's definitely silver. Okay, let's see what else is out there. Uh, RR again, new currency should be backed by gold to restore confidence in money. I'd agree with that, because I think if some new currency is going to come in, people have probably been traumatized in some way where they are going to need something solid to put their trust again in governments and central banks. And so for that reason, I'd agree because I think it is going to be a bit of a uh, traumatic time, eventful time, I should say. And again, having it backed by something, I think is going to be needed. Again, just for the psyche, the psychological um, understanding of money again. Once that new currency comes into play. Okay, let's see. Okay, you guys got some pretty interesting things going on that I don't want to don't want to repeat there, but hey, it's okay. Let's see. Uh, Norman Liu, they're buying on paper, rolled in an ETF, and in the right hand sells to the left hand, and so when you wake up, your physical metal has been dropped once again. Well, they are. It's tough, because on the left hand, yeah, paper. On the right hand, bullion, physical bullion. What do you do? The paper seems to be more favorable if you're looking at a quick turnaround. But the physical, the bullion is more favorable if you're looking for an insurance and a generational wealth protection. So again, it just depends on how you see things or what your needs are. So but going back to what Jeff said, IMF and money, um, if that SDR were to come into play, you know, again, I think some pretty significant things must have happened. And I think one of those things along the way, which we're going to spend the rest of the time talking about, is going to be bail ins. And, for some people, it seems like some type of a fantasy bail in. What is that? You're making up things, type of a deal. But it's a real thing. It's a real thing. So let me get started by first saying what a bail in is. Because, again, if the IMF takes over, or a new monetary system comes in, something had to have happened to the old system where a lot of things got in a lot of trouble. And one of the things that are on the plate to help get us out of trouble, or help get us out of trouble, I guess, are bail-ins. So here's a short clip on what bail-ins are.
Bail-ins. Let me explain quickly what that is. Banks have a hard time because they often make terrible mistakes. That is, they invest money by loaning it out to people and businesses who can't pay it back. When that happens, the bank is supposed to use the capital of the people who got together to create the bank, the capital of shareholders if they sell shares to the public, to deal with their mistakes, to fix the damage of folks they lent to who can't pay it back. It's the job of the bank not to lend to people who can't pay it back. So when they don't get repaid, like happened on a massive scale in 2008 and 9, you know what the banks do. They don't want to use up their own money, so they go to the government to get a bailout. The problem is the politicians who give banks big bailouts, as they did, get to be hated by the mass of people who understand very well what's going on. That private banks, to make private money, want the government to bail them out, and they don't want to have to do it. But the banks don't want to do it. So here's what the banks and the politicians got together. They found another sucker. You know who it is? The depositor. It turns out that the laws have been rewritten, starting with a bank in Cyprus that went belly up a few years ago, to allow banks, when they can't recover money they lent and should not have lent, they don't now have to go to the government to get a bailout. They can get a bail-in. You know what that is? Taking money from the depositors who put money in the bank and simply taking it to recoup their own capital that they can't get back from the people they lent to. Is it legal to have a bail-in, to take the money of the depositor and not give it back to them? The answer is yes. In many countries, including the United States, the laws now allow a bail-in. Should that upset you? Uh-huh.
All right. So, bail-ins, they are real, they are legal, and why bail-ins will be the new bailout from Investopedia. Financial crisis of 2008 ushered in the term too big to fail, which regulators and politicians used to describe the rationale for rescuing some of the country's largest financial institutions with taxpayer-funded bailouts. Heeding the public's displeasure over the use of their tax dollars in such a way, Congress passed the Dodd-Frank Wall Street Reform and Consumer Act in January 2010, which eliminated the option of bank bailouts but opened the door for bank bail-ins. Kind of makes you wonder, what did they really achieve by doing this? Nonetheless, the difference between the bail-in and the bailout. A bail-in and a bailout are both designed to prevent the complete collapse of a failing bank. The difference lies primarily in who bears the financial burden of rescuing the bank. With a bailout, the government injects capital into the banks to enable them to continue to operate. In the case of the bailout that occurred during the financial crisis, the government injected $700 billion into some of the biggest financial institutions in the country, including Bank of America, Citigroup, AIG, familiar names. The government doesn't have its own money, so it must use taxpayer funds in such cases, according to the U.S. Treasury Departments. The banks have since repaid all of the money. With a bank bail-in, the bank uses the money of its unsecured creditors, including depositors, that's you and me, and bondholders, to restructure their capital so it can stay afloat. In effect, the bank is allowed to convert its debt into equity for the purpose of increasing its capital requirements. A bank can undergo a bail-in quickly through a resolution proceeding, which provides immediate relief to the bank. The obvious risk to the bank depositors is the possibility of losing a portion of their deposits. However, depositors have the protection of the FDIC, Federal Deposit Insurance Corporation, which insures each bank account for up to $250,000. Banks are required to use only those deposits in excess of $250,000. Okay, well, that is something. That is something. We're gonna have to remains to be seen. So anyway, just get through a couple more paragraphs here. The provision for bank bail-ins in the Dodd-Frank Act was largely mirrored after the cross-border framework and requirements set forth in Basel III, International Reforms 2 for the banking system of the European Union. It creates statutory bail-ins, giving the Federal Reserve, FDIC, and Securities and Exchange Commissions the authority to place bank holding companies and large non-bank holding companies in receivership under federal control. Since the principal objective of the provision is to protect the American taxpayer, okay, protect the American taxpayer. Banks that are too big to fail will no longer be bailed out by taxpayer dollars. Instead, they will be bailed in. So, a couple things with this one. Couple things. The first one, yeah, your money is insured up to $250,000. So the bank is they only can skim off the top or what's above that $250,000. That's what the bank legally can take, and the 250,000 is insured by the FDIC. What's above it is not. I have a problem with that in that you know, let's say the bank takes you have 300,000, the bank takes the whole 300,000. You're going to tell the bank, "Hey, I'm supposed to be insured. My first 250,000 is insured." And let's just say the bank tells you, you know what? You're correct. Mr. John Doe, you're correct. Can you fill out this just fill out this claim, give it back to us, and we'll get back to you. And what do you do after that? I mean, the FDIC is insuring your money still, but you may have to wait to get it now if the bank decided to use it in whatever way that they saw fit. So, I for me, I think FDIC meant something decades ago, but I think today it doesn't mean much. Doesn't mean much where that the bank can just simply still take your money and tell you, you know what, you're right, you are insured. Can you just fill out this form and we'll get back to you later? So, I mean, I just don't think FDIC means too much today, or any insurance means too much today. And the other part that caught me was when it started talking about different countries in Europe. There had to have been some type of or needs to be some type of legal framework to go through. I mean, if there's a bail-in, to go into different countries and start conducting your bail-in. Let's say, I don't know. Let's say if you're a bank in the U.S., but you also have that same bank has a branch in Malaysia, has the same branch in in Italy, or whatever it is. How would you make it legal to be able to take a depositor's bail-in um, in a different country? How do you make that work? So that was the other issue that I kind of came upon that wasn't sitting too well with me, and I was trying to figure it out. So I went and found this article, "Why Bail In and How," and it's an article by this gentleman here, Joseph H. Summer, and he is assistant vice president and counsel at the Federal Reserve Bank of New York. Okay, so he knows a little bit of something, right? And so he wrote this paper, and I tell you, it's pretty amazing to see how casual their thinking is about bail-ins. So I'll run through it pretty quick. Financial firm insolvency is very different in kind than the insolvency of ordinary firms. Key distinction is that only financial firms are dominated by financial liabilities. Bail-in insolvency process respects this distinction, converting the claims of the parent company's creditors to equity while paying the subsidiaries' creditors on time and in full. Bail-in impairs only the non-financial liabilities in the parent and preserves the financial liabilities in the subsidiaries. It therefore preserves the firm's liquidity and risk-shifting abilities. For systemically important financial firms, bail-ins averts systemic risk. Okay, so two questions. Why should bank regulators dislike standard insolvency law? And why should bail-ins make them happy? Why should bail-ins make them happy? Again, it's amazing for me to see how casual they can be when they talk about a topic such as bail-ins. Okay, why mega banks are different? Mega banks are more than big banks. They are more complex. They are more interlocked. They are more global. So this is the part, the jurisdiction parts, right? They also have a peculiar corporate structure and, most importantly, peculiar liabilities. Mega banks are highly leveraged. Their liabilities are generally financial products, often very liquid. Finally, mega banks are conglomerates with close connections among component entities. The business of mega banking, several traits stand out: personal interconnections and a global reach. These all affect mega bank insolvency. Mega bank insolvency is different from that of other businesses. Almost all financial firms are highly leveraged. Debt to equity ratios of 1 to 1 are typical for ordinary firms, the widget maker of the textbook. Financial firms' debt equity ratios are much higher, about 15 to 1 to 30 to 1. 15 to 1 to 30 to 1 for banks and securities firms, and somewhat less for insurers. The leverage has some implications. Okay, let me scroll down a bit. Hang on. Let me go through it. I'll get to some of the more important parts. But again, the way it's spoken of is fairly casual, and it's kind of amazing. Hang on, let me get back to that part. Okay, so bail-ins, the mechanics of a bail-in. Bail-in is a stripped down form of reorganization working at warp speed. The bail-in process should create a well-capitalized firm the next morning before the financial liabilities have had a chance to run. The hope is that this process works as smoothly as a recapitalization with government money, with no government money at risk. Mega banks are conglomerates, not unitary entities. However, then, to instantly recognize the non financial debt of conglomerates without touching a financial debt. Such debt might exist in many entities in many jurisdictions. Okay, so here's the part again: jurisdictions, right? The creditors might be affiliates. Overnight reorganization of such debt requires a tremendous amount of information and coordination. Jurisdictional coordination. This task is an impossible one. Well, not entirely. The creditors of a solvent subsidiary are paid in full even if the parent is insolvent. And finally, a parent reorganization involves only one entity. Only one jurisdiction is responsible for the parent's insolvency. One set of rules, one set of acts, and one set of incentives. International insolvency law works better for single entities than their conglomerates. Bail-ins begins before it begins. The regulator must prepare for the bail-in well in advance. There are two pre-initiation processes: fast and slow. Slow process is one of discourse with clearinghouses and foreign regulators. The goal is not agreement, but the formation of reciprocal expectations. The clearinghouses and foreign regulators expect the parent regulator to rescue all relevant subsidiaries at the expense of the parent. The parent's regulator expects cooperation in return. These expectations are not mutual obligations. There are no obligations until the parent regulator decides to rescue subsidiaries. Okay, so let's take a look at the fast process, which more than likely it's going to be, because if anybody were to get wind that a bail-in is coming, they're going to withdraw their funds, and then that defeats the purpose of a bail-in. So I would expect a fast process, and the fast process is fast indeed, days or even hours if necessary. The fast work is all done. Only one operation on the balance sheet remains, but this takes some time. Who gets the new equity? Sorry about that. I think I might have lost a note in there. Um, okay, just get through a couple more paragraphs. Sorry about that, guys. Okay, The distribution of equity is the end of the legal process. So the end is once they distribute that equity, legal process, but not the distribution of equity is the end of the legal process, but not the end. Okay. The reorganized bank will have a strong balance sheet, but may not have a strong business. The mega bank probably became troubled in the first place because its operations were insufficient, insufficiently probable, or perhaps too risky. The mega bank will have to shed its bad operations. This is not a primary task for the bail-in, which, apart from installing new management and maybe governance, works mostly on the balance sheet. Okay, I mean there's a few more things, but I know it's been taking a while with that. The thing with the bail-ins, there is a jurisdictional issue that had to be fixed, had to be solved. And the other thing about the bail-ins, it doesn't have to be all banks all together at one time. It can be one bank. It can be just another bank. It can be just another bank. And we saw that in Cyprus, right? I mean, uh, it was just that bank, and it was controlled, it was contained. Some people will say that was a test of bail-ins to see how it went. But the bail-ins, again, they had that issue of jurisdictional um, uh, jurisdictional legalities. So what they did was, when they met back in Brisbane. Okay, the new G20 financial rules, Cyprus style bail ins to confiscate bank deposit and pension funds. Okay, so there's your pension again. So on the weekend of November 16th, the G20 leaders whisked into Brisbane, posed for the photo ops, approved some proposals, made a show of roundly disapproving of Russian President Putin, and whisked out again. It was all so fast that they may not have known what they were endorsing when they rubber stamped the Financial Stability Board's adequacy of loss absorbing capacity of global systemically important banks in resolution. Oh, what a title! Which completely changes the rules of banking. Russell Napier, writing in Zero Hedge, called it the day money died. In any case, it may have been the day deposits died as money. Unlike coins and paper bills, which cannot be written down or given a haircut, says Napier, deposits are now just part of commercial banks' capital structure. That means they can be bailed in or confiscated to save the mega banks from derivative bets going wrong. Rather than reining in the massive and risky derivatives casino, the new rules prioritize the payment of banks' derivatives obligations to each other ahead of everyone else. That includes not only depositors, public and private, but the pension funds that are the target market for the latest bail-in play called bail-inable bonds. Again, pensions, 401ks have to understand it and take care of it. Bail-in has been sold as avoiding future government bailouts and eliminating too big to fail, but it actually institutionalizes too big to fail, since the banks are kept in business by expropriating the funds of their creditors. It's a neat solution for bankers and politicians who don't want to have to deal with another messy banking crisis and are happy to see it disposed of by statute. But a bail-in could have worse consequences than a bailout for the public. If your taxes go up, you will probably still be able to pay the bills. If your bank account or pension gets wiped out, you could wind up in the street or sharing food with your pets. Okay, that's a pretty rough way to look at it. Okay, so bail-ins in plain English. Financial Stability Board now regulates banking globally. This is a global thing now. So this goes back to that jurisdictional issue, right? How are they going to do it across various jurisdictions? Well, Financial Stability Board now regulates banking globally, began as a group of G7 finance ministers and central bank governors organized in a merely advisory capacity after the Asian crisis of late 1990s. Although not official, it mandates effectively acquired the force of law after the 2008 crisis when the G20 leaders were brought together to endorse its rules. This ritual now happens annually with the G20 leaders rubber stamping rules aimed at maintaining the stability of the private banking system, usually at public expense. Okay, so let's see if I can find anything else here. But what this essentially did with the G20 was it allowed for bail-ins, but it also allowed that ability to be able to move across various jurisdictions, and so they solved that problem. And again, this is something I think it's not on the radar anymore of people. We don't hear about it much. We don't think about it much, but you start connecting the dots again, looking at what the Fed is doing, knowing that investors and banks, institutions are getting back into collateralized debt obligations. Um, Looking at, again, this repo market. Why are the banks needing so much cash all of a sudden again? Like it's a life and death thing where all of a sudden we have to flood these banks with cash again, and we were told it's to meet reserve requirements and this and that and this and that. It's getting hard to buy anymore. So you look at the end game, or one of the things of the so-called end game, which is bailouts or bail-ins, which is already set up. It's already set up for banks to go ahead and take your deposits, even your pensions. And again, it's something we all need to be aware of, because this is, I mean, if this goes down, a lot of us are not going to have time to recover, much less get through it all. And so this kind of took me back to a couple clips that I found of Jay Powell and one with Bernanke.
Are American banks safe today?
The American banking system is much, much stronger and more resilient than it was before the financial crisis. Particularly the largest banks have double or more the amount of capital, which is to say resources, to absorb losses. In addition, we've required them to undergo resolution planning in case they do fail. There's a plan for what to do, which doesn't involve a taxpayer bailout.
Okay, so there's a plan to do which doesn't involve the taxpayer bailout. Okay. It's almost comical already at this point, where they don't want to call it taxpayer. But the thing is, if you had money in a bank account and you're paying taxes, you're a taxpayer that paid for it anyway. So, they're trying to, play with words here and there, but the meaning basically is the same. All they're saying is the government this time is not going to bail out the banks. We are. Or we're going to be part of what is going to bail out the banks. And already we're seeing the Fed, in some sense, having to do a little bit of bailout going on with all these repos. I'm not sure if bailout is the right word, but when they say taxpayer, it's all political, meaning they want the average person to feel better knowing that we're not going to use your money. Taxpayers won't pay for this. And then there's a feeling of calm, I guess, amongst most of the people. But what they're not saying is, but we will reach into your bank account and take your money if the bank needs help. They're not telling you that part of it, right? So what does it matter, taxpayer money or not? I think it's really maybe I'm being too critical, but I think it's the trust is gone. The trust is entirely gone at this point already, and it's just a play of words. Where if you're not informed, you will never know. If you are informed and you're woke, you will know and you'll understand. So one more clip with Bernanke, and I'll get back to chat. I know you guys are chatting a bit out there.
Last month, Bernanke announced the Fed's intent to buy $600 billion in U.S. Treasury securities, which is supposed to have the effect of lowering rates on long-term loans for things like cars and homes. Bernanke wanted to emphasize that these are the Fed's own reserves. It's not tax money, and it doesn't add to the federal deficit.
What did you see that caused you to pull the trigger on the $600 billion at this point?
It has to do with two aspects. The first is unemployment. The other concern I should mention is that inflation is very, very low, which you think is a good thing and normally is a good thing. But we're getting awfully close to the range where prices would actually start falling.
Falling prices lead to falling wages. It lets the steam out of the economy, and you
Exactly.
start spiraling downward.
Exactly.
You were skeptical at one time of some of the things that Chair Bernanke did during the financial crisis.
So I and a number of others raised questions about quantitative easing, and I felt that was my obligation and the right thing to do. I hope I did it in a constructive way. And some years ago, I came to the view that that the risks I'd identified really didn't come to bear. So I did support the actions that Ben was proposing as chair, and it's we try to learn from these things. These are some of these things that don't have a precedent. And so you've got to go through them and bring your best thinking and then learn lessons from what's happened.
Okay, some things don't have a precedent, aka we're still experimenting and we're not sure what to do, but we're going to make it up as we go along. What else? I mean, how do you take these things, right? Yeah, I apologize. I'm always a cynic here, but it's getting harder and harder to trust the people at the top anymore, right? So anyway, I know your chat. You guys been having some pretty good chat going on. So let's see who watches Greg Manarino. I do. He's been on a tirade lately. He's not too happy with things. Smart guy. We've been trying to get him on the show, but he's, we've never got a response from him yet. None whatsoever. So let's see. Lynette and Max Kaiser are also good. Yeah, Lynette does a good job. She took some heat a couple years back from Andy Hoffman and such, but I'm for Lynette. She does a very good job, and we even tried to get her on, but she hasn't responded either. Max Kaiser, excuse me, bit of stuffy nose still. Max Kaiser, I think we've even tried him as well. We've tried all of them. No luck yet. But Max Kaiser, his show is very good. I like the way he breaks things down. Lynette, I love the way she also breaks things down. She makes it very simple for all of us to understand. So I appreciate all of their work. Greg, Lynette, Max, all their work. It's really good. If you haven't watched them, give them a try. They're all pretty good. Okay, Truth Teller. They just print or push a button. These guys need to go to jail. I wish I could print some money on my copying machine, do what they used to do in 1800. Yeah, it's getting, I keep saying this, it's getting harder and harder, when you see why are certain companies given cash and others not. It's getting more and more difficult to see yourself as part of part of a nation, part of a country, because what you're seeing is there are some people here and some people there, and I think more and more we are starting to see it, and again, I mean, I come back to this. This is one reason, if not the biggest reason, why getting into gold and silver is probably one of the better things you can do. Again, it's because you look at central banks; they're buying up gold. Get some gold for yourself. Get some silver for yourself. And you look at again now these banks needing cash. Well, if they need cash, I need my cash too. So I would not be leaving it with the banks, especially with what we know about bail-ins. Bail-ins are legal. It's can cross borders, so you may not be as safe as you think if you're in a, if you have something in the U.S. and you're over in Italy, so you have an account in Italy or whatever it is. Jurisdictionally, the bank can do that. Gold and silver, you're out of the banking system somewhat. You can store your wealth with it, especially when that cash starts to fall. I mean, we talked about earlier how all of these currencies seems like they're on a little parachute, slow drift on the way down. So as that starts to all go down, people are going to flock to something that can hold the value of their cash. They are going to be looking into gold and silver. Historically, that's where people go. And it's good to be there. It's definitely good to be there. And again, the insurance aspect. If there is, that not if, but when that new monetary system does come into play, as some of you guys mentioned, being gold back, it's going to have to be in order to get confidence again in people, because money is all about confidence. If we believe something to be money and we have confidence that it's money, we're going to allow it to be money and act as money. And whatever they do, I think they are going to have to incorporate, at least gold in some way in order to have the confidence of the people again. Okay, let's see. Winging it, Tracy. I used to think Jim Willie was a nut, but not so much anymore. Jim Willie, you have to get through. You have to watch 2 or 3 episodes before you can start to maybe understand or comprehend what he says, and then kind of see that maybe he is making sense. Or in this thing, maybe not so much. In this thing, yeah, he's making sense. So you got to give him time. You know, you have to give Jim time. He's been in it for a long time, so to try and catch up to where he's at, it takes a few episodes to watch, and it takes a few understanding. It takes some understanding of who he is to 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 understand him. Basically, he can take a while, but he's Jim is good. I like Jim also. Okay, let's see. Rogue Silver, Chris Dwayne. He's good, but you have to know about Silver before watching him because he says some crazy stuff. Yeah, Chris Dwayne. He fundamentally he knows Silver very well. No disagreeing with him on any of those types of things. And then I think he went into micro minting. I think he called it. He kind of lost me there. But fundamentally, he knows Silver and he knows why Silver. But on the business side with the micro minting, that's his choice. Some people they see it, some people don't. Free to have opinions, right? But I like Chris. I do like Chris as well. Okay, wise words about Jim. Yeah, Jim is good. Just you gotta give yourself time to understand Jim, and then I think more than likely you may be on board with what he has to say. Uh, yeah, you have to let him rant. It's the same with Gerald Salente. When I first came across him, it took me a while to figure him out and understand him, but he's got me in his corner now. Gerald, he knows the markets, he knows the history, he's been in the political circles, so I think he's another one. um and he's going to entertain you. He will definitely entertain you. If you interview him, you may have to go in with expectations that your video is not going to be monetized because he's going to say a few choice words and whatnot, but it's not about the monetization anyway. It's about sharing the information, right? So Gerald Salente, I love that guy also. Catherine Austin Fitz, yes, we've been trying Catherine as well. She's I know she's always busy, but we'd love to get them on. We've been trying Big Swear, Catherine Austin Fitz. We've been trying Lynette Zhang. We've been trying Max Kaiser. But I do think coming up, we were supposed to have Danielle DiMartino Booth, but her schedule got a bit tight. I mean, I think you guys understand. She's always on, the business morning shows and whatnot. So her business was kind of tight, and so we had to move it back a bit. But Danielle DiMartino Booth, she should be coming up hopefully soon. And Rob Kirby, we're going to have him back. We're going to talk to him as well about a few things. So we'll see how those guys go, if we can get them on soon. Which kind of takes me to later on this week. If we can get the interview done, we'll try and get it out for you this week. If not, I do apologize, but we need to try and really get them on, and then push through the editing and things like that. Editing, because you folks know we go ahead and put all these timestamps and lower thirds and all these things, so it's not just a straight shot interview to YouTube type of a thing. We have to break it down a bit, and just to make it a little bit more concise for you guys. So give us a little bit of time with that. So a few more questions, and then I'll be heading out. Still battling a little bit of a cold here. Okay, let's see. For the past 3 to 4 weeks, Neomot, 3 to 4 weeks, I've been withdrawing my money from the bank the day a payment hits. I keep less than 100 pesos in the bank. It gives me peace of mind. Yeah, I mean, if you're able to keep some of it on you or around you safely, it's not a bad idea. I mean, it's not just me. You can go back to Jim Rickards and whatnot. A lot of these guys, they're on the record as saying, have cash on hand, and it's not just for the the crisis type of a thing where ATMs are only going to give you $50 a day or whatever it is. It's because I think we can all see it already. The writings on the wall. It's almost etched in stone. Sad to say, but we know these things are going to happen, and we have to, like I say, you're either going to be a blessing or a burden. We have to do the things that are going to allow us to be a blessing, because frankly speaking, there are going to be a lot of burdens out there. A lot of people we know, they're going to have a tough time, and we have to let them understand. Look, when you come into gold and silver, it's not just the price. Don't be fixated on the spot price. You should be fixated more on what the Federal Reserve is doing, fixated more on what the banks are doing, fixated more on where the world is at right now, economically, financially. Those are the things you should be fixated on. And once you get that part of it, then doesn't matter rich, poor, whatever it is, that's where you start to understand the price of gold and silver is a small part of understanding gold and silver. It's the part where you understand, if currency gets in trouble, my currency can retain the value if it's in gold and silver. You removed it from paper, you put it into something else. So now the value of that is in the something else, the gold and silver. It's insurance where, again, if things go bad, it's going to store your wealth. If a new currency system comes in, I think we all are kind of looking at, it is going to have to be backed by something, and we already know central banks, they've been buying a heck of a lot of gold. They're buying it. You should buy it as well. They're buying it for a reason. Okay, it's generational wealth. It'll last. It will be there long term for you, for your family. So again, it's not just the price that you're looking at. You're looking at what it can actually do for you. So, someone mentioned trolls earlier, and yeah, we always get it. Haha, gold and silver fell, da 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 da. For us, we don't. I mean, for me personally, it doesn't bother me, because I would tend to believe that maybe that person just doesn't truly understand gold and silver. He's just looking at the price. So, benefit of the doubt. But for us, as we move on, we gotta stay firm in knowing where we are exactly in the world right now, as far as monetary systems and things like that, and knowing that there is going to be a transition at some point, and probably one of the best things to get through that transition is going to be having that gold and silver. So don't be so fixated on price. Be more fixated on what's going on in the world, because you do have an exit, you do have an out, you do have a way to protect yourself, and there are going to be opportunities that are going to come up in that time of uncertainty. So you have to have faith in that, and know that what you're doing is going to be the right thing, if in case things, I shouldn't say if in case, or when that time comes. I mean, I don't think any of us are going to be there, cheering with our pom poms. Yeah, we told you. I don't think any of us are going to be like that at all. But do what you need to do to take care of your family. Okay. Let's see. Tony Peterson, I appreciate it. Okay. Let's see. They don't want to get, okay. Nameless. Why do coin dealers take money for gold if money is more valuable? But they're trading right now. Every dealer, shouldn't say every dealer, but I think most dealers do have a good amount stored stored away. And it's like gold and silver is not your only investment. You can have a business, sell a product, get some profits, put those profits into something that may earn a little bit quicker for you, and then go ahead and take some of that and put it into other things as well. So you know it, I think most people know the gold and silver, like I say, it's not a quick flip. It's something that over time does its job, and does its job very, very well. So you're not locked into that and only that. There are other things, and that's why a lot of these guys will say 10% of your portfolio gold and silver. And that's your balance. That's your counterweight in case all of these things go bad, because this guy is expected to shoot up. So, there are a lot of reasons. Okay, let's see. Rogue Silver, I do out up some content myself. So, okay, spreading the okay, great. Rogue Silver. We'll have to check you out sometime. Polynesian Pip, Rob Kirby rocks. Yeah, he does. He does. So I'm hopeful our interview remains scheduled. So we're trying to also reschedule with DiMartino Booth, Danielle DiMartino Booth. So hopefully we'll get a break on those. Okay. Tony Peterson, coin dealers trade metal for paper to create profit to buy more precious metals. Yeah, I mean, in general, I think coin dealers they are pretty faithful though. That's they are pretty faithful to gold and silver. I don't think I know one guy that got into gold and silver just for the money. I think they got into it. Guys I know, they got into it because there was a passion for it. There was an understanding of it, and an understanding of, like I say, the things we need to focus on with the banks, with the governments. And so, it was their way to open up a business, get into a passion that they like, and find a way to help people as well. It's not always about the money. Okay. Thomas Tubes, for what it's worth, I like junk silver. I do too. I love my junk silver. I'm a junk silver guy. I don't know if you guys can see this, but yeah, this is, well, not so good. Oh, there you go. So this is one from 19. Let me check. 19 no, 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 1903. This is one of my favorite ones. But junk silver, I like junk silver. U.S. junk silver, European junk silver. I think those are always pretty cool. Pretty cool to have. Okay. All right. So I guess we'll about wrap it up. Bill Holter, yeah, we're gonna have to get back with Bill Holter as well. Peter Taradash, no, haven't heard him. I'll see if we can we can take a look at Peter. Okay, Grandpa. Okay, we'll get in touch with Grandpa. Okay, so I guess that'll about wrap it up for this week's live stream. I thank you guys for being with me. I know my voice and my nose is a bit, well, I don't know. It's getting in the way a bit. So I thank you guys for putting up with it. And again, just take care of each other. Be a blessing, not a burden. Spread the word if you can, as best you can. And just saddle up and get ready for what's coming ahead, and silver up as well. And I'll see you guys next week. You all take care of each other, and again, just be that blessing, not the burden. Take care, guys.